Welcome to another FAR walkthrough video from SuperfastCPA. I'm Logan, and in today's video, we're going to be going over FAR Area 3. This is Section F. This is an application topic. Calculate the carrying amount of lease-related assets and liabilities, and prepare journal entries that a lessee should record. And we're going to be doing that the SuperfastCPA way, which is diving straight into the questions to learn the material. If you don't know much about our strategies, make sure you go to SuperfastCPA.com and sign up for our free 1-hour webinar training where we will teach you the key ingredients to passing the CPA exam. Again, it's 1 hour, it is free, and we will show you how to pass the CPA exam without wasting months or even years of your time. And after you watch that, you're going to want to learn more, so make sure you check out becoming a SuperfastCPA Pro member. SuperfastCPA Pro members get access to the Pro course, where we teach in detail exactly what you're supposed to do every single day, so it's basically a much more in-depth version of the webinar with every single little detail fleshed out for you. But also, just letting you know, SuperfastCPA Pro members get access to the full 10-question versions of these 5-question YouTube videos. So I make 5-question YouTube videos usually, but SuperfastCPA Pro members get access to the full 10-question versions so that they can learn a little bit more, maybe a few more pieces that we don't talk about in these videos, and things like that. So again, if you want to learn more and if you like these videos, make sure you become a SuperfastCPA Pro member and you'll be able to access those 10-question videos. With all that said, let's dive straight into the questions. All right, here we are at question 1, and something I want to say is if you've watched the previous video, this will be a little bit more helpful. So if you haven't watched the previous video where we talk about the different lease classifications, then this video won't make as much sense, but it will still be helpful, of course. So make sure you watch the previous video where we talk about the lease classifications, finance lease, operating lease. But with that said, let's dive into this question. One thing I always like to point out is as you dive into the questions, make sure you read the last part of the question first, basically the last sentence, because usually that is what gives you context for what the question is talking about. So we'll read this last part here, and again, think of this from the test day perspective. You're going to be seeing 50 or 100 different topics, and you have no idea what you're going to be seeing. So read the last part of the question first so you immediately know what kind of a question you're dealing with. So let's read this. What is the initial lease liability to be recorded by the lessee? So if we were at test day, we would immediately know we're dealing with lease liability. Whereas if we hadn't, we would have to go all the way up here and be reading, and we wouldn't even know necessarily that we were dealing with a lease liability until we got to the bottom. So again, read the last part of the question first. So now that we know we're dealing with a lease liability, let's go up to the top. A company signs a lease on January 1st, year 1, for a piece of equipment with the following terms. The lease payments are going to be $25,000 annually due at the end of each year. The lease term is 5 years. The implicit rate is 6%, and that is known to the lessee. And by the way, that does matter, so we'll talk about that in a little bit. Incremental borrowing rate is 8%. The useful life of the equipment is 6 years. The fair value of the equipment is $120,000. And the lease transfers ownership of the equipment to the lessee at the end of the lease term. And a little bit more information that we're going to need. Here are some present value factors. The present value of an ordinary annuity factor for 5 years at 6% is 4.212. The present value of an ordinary annuity for 6 years at 6% is 4.917, and for 5 years at 8% is 3.993, and for 6 years at 8% it's 4.623. And we're going to need to know which one of those to use for this, and that's why we're going through this. I'm going to teach you which one of those factors you're going to use for this question. So again, with all that information, what is the initial lease liability to be recorded by the lessee? If you have no idea how this works, if you don't know how to calculate the lease liability based on all this information, that's okay. That's the point of these videos. That's the point of these questions. We are using these to learn how to do the material. So if you don't know, that's great. We're going to look at the answer together. If you have an idea, pause the video and try it yourself and come back when you're ready. All right, here we are. The answer is B. $105,300 is going to be the lease liability. So let's walk through this. The lease meets the criteria for classification as a finance lease because ownership transfers to the lessee at the end of the lease term. And again, we talked about that in the previous video, how to classify a lease as a finance lease or an operating lease. And I'm just going to say it up front, pretty much all of these are going to be finance leases. That seems to be the main focus for the CPA exam, is knowing how to calculate all these different things for finance leases. So that's what we're going to be doing. The initial lease liability is calculated as the present value of the lease payments. The implicit rate of 6% is used because it is known to the lessee and is lower than the incremental borrowing rate of 8%. So that's another important thing you need to know. Typically, you use the implicit rate, which is the rate that's like part of the lease, as long as it's known to the lessee, and as long as it's lower than the incremental borrowing rate that is also usually mentioned. If it's not lower than the incremental borrowing rate, you use the incremental borrowing rate, although usually it is lower. The correct present value factor is for 5 years at 6% because that's the lease term. The useful life was 6 years, but the lease term is 5 years, so we use 5 years. So the present value factor of 5 years at 6%, which is again the implicit rate, is 4.212. So we use that to calculate the present value of the lease liability. We take the annual lease payments of $25,000, multiply it by 4.212, and that gives us $105,300. That is the lease liability at the very beginning of the lease, before they've made any payments or anything like that. That's what you record. And this would be the journal entry, by the way. You debit a right of use asset for $105,300, and you credit lease liability $105,300. So that's some of the basics that we're going to be using throughout the rest of the video. You figure out the correct present value factor to use, and you multiply it by the annual lease payments, and that typically gives you the present value of the lease liability at the very beginning, and that's what you're going to record as the lease liability. Now, with that knowledge, let's go to the next question. All right, here we are at question 2. What is the lease liability that Riverstone Technologies should record on January 1st, year 1, immediately after the first payment is made? So this is a little bit different. Let's go up to the top. On January 1st, year 1, Riverstone Technologies enters into a lease agreement for office equipment. The agreement requires annual lease payments of $40,000, with the first payment due immediately on January 1st, year 1, and subsequent payments at the beginning of each year for the next 4 years. The implicit rate in the lease, known to the lessee, is 5%, and the incremental borrowing rate is 6%. The equipment has a fair value of $200,000, and ownership of the equipment transfers to Riverstone Technologies at the end of the lease term. The present value of an annuity due factor for 5 years at 5% is 4.546, and the present value of an annuity due factor for 5 years at 6% is 4.465. So again, with all that information, we have to figure out what the lease liability is on January 1st, right after they make the first payment. So this is pretty similar, but a slightly different situation. So take what you learned from the first question, and you might be able to figure this out. If you still don't know what we're doing, though, that's okay. We're going to look at the answer. But again, try to use what you learned from the first question to at least do part of this. And when you're ready, come back. We will look at the answer together. All right, here we are. The answer is C, $141,840. That is the amount of the lease liability on January 1st after the first payment. So let's walk through this. The lease meets the criteria for a finance lease. And again, that's pretty much what we're going to be dealing with throughout this video. It seems to be the main focus. And it is a finance lease because the ownership transfers at the end of the lease term. So let's go through this. Step 1, calculate the present value of the lease payments. We did this in the first question, so let's do it again. The present value of the lease payments is calculated using the present value of an annuity due factor for 5 years, because that's the life of the lease, at the implicit rate of 5%. And again, we use that because as long as it's known and as long as it's lower than the incremental borrowing rate. So $40,000 multiplied by 4.546, which was that present value factor up above, is $181,840. Now we go to the next step, which is taking into account the first payment. And you might be wondering, how does this work? It's actually pretty straightforward. The first payment of $40,000 is made immediately and reduces the lease liability in full. Since the first payment is entirely principal, the lease liability on January 1st, year 1, immediately after the payment is the $181,840 less the $40,000 payment. The full $40,000 payment reduces it, so the lease liability is actually $141,840. We haven't even taken into account any interest or anything like that because they immediately paid it on the first day of the loan. So that is how you take into account a payment made on the same day that the loan starts, is it all counts as principal. So you reduce the lease liability, which you calculate by the present value of the lease payments. You reduce it by the first payment in full, and that will give you the actual lease liability that's going to be carried forward for the remaining years. So that's another thing we needed to learn. Let's go to the next question. All right, here we are at question 3. What is the carrying amount of the lease liability at the end of year 2, immediately after the second payment is made? So now we're dealing with not the initial year, but we're going to the next year. On December 31st, year 1, Boulder Equipment Leasing enters into a lease agreement with annual payments of $80,000, with the first payment due immediately on December 31st, year 1, and subsequent payments at the end of each year for the next 8 years. Ownership of the equipment transfers to Boulder at the end of the lease term. The implicit rate in the lease known to Boulder is 4%. Present value of an annuity due factor for 9 years at 4% is 8.111. So with all that information, what is the carrying amount of the lease liability at the end of year 2, immediately after the second payment is made? So we've learned how to make the first payment and everything. So now we're going to learn how to make the second payment. This might not be that intuitive, but maybe it's something you've seen before. So if you want, go ahead and pause the video. If not, let's go ahead and look at the answer together. All right, here we are. The answer is B, $511,635. That is the carrying amount of the lease liability at the end of year 2. So let's walk through this. The lease meets the criteria for a finance lease, again, because the ownership transfers to Boulder at the end of the lease term. Of course, that's not the only way that something is classified as a finance lease. We'll see a little bit more in other questions, but the main focus of this video is what you do after it's a finance lease. Once you classify it as a finance lease, how are you calculating the lease liability and things like that? So that's why we're not doing a big focus on all the different criteria for making something a finance lease. We're focusing on how to calculate it after you know it's a finance lease. Step 1, calculate the initial lease liability. We've done this before. Present value of lease payments is the $80,000 payments times the present value factor of 8.111, and that's $648,880. And since the first payment is made on the first date of the lease, like on the same day the lease is created, you immediately reduce the lease liability by that amount. So $648,880 less $80,000. And remember that all counts as principal, and that gets you to $568,880. So that is the amount of the lease liability on the first date of the lease going into, the remainder of the lease. And that is the amount that we're going to be using to calculate interest and principal. So now we're going to calculate the December 2 payment and everything like that. So to do that, first we have to take the amount of the lease liability that there is remaining, so $568,880 after the first payment, multiply that by the 4% interest rate, and that gives us $22,755 of interest. Now we take this interest and we subtract it from the lease payment that there's going to be each year, so $80,000, that's the full payment, less $22,755, and that gives you a principal reduction of $57,245. So when it comes to figuring out the amount of principal that's reducing the lease liability each year, you take the lease liability that there was from the previous year, at the end of the previous year, multiply it by the interest rate, and then take that interest, subtract it from the lease payment each year, and that gives you the principal reduction. And so you're going to take this principal reduction and subtract it from the lease liability, $568,880, and that was the ending year 1 lease liability, and we subtract $57,245 of principal in year 2, and that gives us $511,635 of lease liability that's going to be the carrying amount at the end of year 2. So that's how you calculate the lease liability being reduced in the following years after the first year, and you would do the same thing in year 3 and year 4. For year 3, you would take $511,635, multiply it by 4%, that would give you the interest, and you would subtract that interest from the lease expense, and that gives you the principal reduction, which it would be different in year 3, of course, and then you would subtract that from $511,635. Again, that was as if you were doing it in year 3. So you just keep doing the same thing over and over throughout the rest of the lease. So that's how you do the lease calculations for the years after year 1. Now let's go to the next question. All right, here we are at question 4. What is the right of use, or the ROU, asset that Alpine Enterprises should record at the start of the lease? So this is something new. We haven't necessarily talked about this too much. We talked about it a little bit in the first question, so you might know how to do this. On January 1st, year 1, Alpine Enterprises enters into a lease agreement for manufacturing equipment. The lease requires annual payments of $90,000, with the first payment due immediately on January 1st, year 1, and subsequent payments at the beginning of each year for the next 5 years. Ownership of the equipment transfers to Alpine at the end of the lease term. The implicit rate in the lease known to Alpine is 5%, and Alpine's incremental borrowing rate is 6%. The present value of an annuity due factor for 6 years at 5% is 5.582, and the present value of an annuity due factor for 6 years at 6% is 5.417. So with all that information, again, we have to calculate what is the right of use asset that they're going to record at the very beginning of the lease. Again, in question 1, we kind of talked about this, so you probably know how to do this. If you don't remember, that's okay, but if you do remember, or if you want to give this a try, pause the video, come back when you're ready, and we will look at it together. All right, here we are. The answer is A, $502,380. That's going to be the amount of the right of use asset that we record. So let's go through this. The right of use asset is calculated as the present value of the lease payments. So it's basically just you calculate the lease payments. The lease liability is equal to the right of use asset most of the time. Since the implicit rate of 5% is known and lower than the lessee's incremental borrowing rate of 6%, that's the implicit rate. The implicit rate is used. So we go ahead and do what we've done in all the other questions. We calculate the present value of the lease payments. We use the present value factor of the annuity due at 5%. So we calculate that as $90,000 multiplied by 5.582, and that gives us $502,380. So that is the amount of the lease liability, and that is also the amount of the right of use asset right at the beginning of the lease. So we would record a journal entry of a debit to right of use asset, $502,380, and credit lease liability, $502,380. So that's how you calculate the initial right of use asset. There's sometimes other factors, but that's the basic idea there. Let's go to the next question. All right, here we are at question 5. What is the carrying amount of the right of use asset on Vertex's year 2 balance sheet as of December 31st, year 2? So this is the following year after the first year. So kind of like how we figured out how much the lease liability is after each year, we're going to figure out how much the right of use asset reduces each year. So let's go up to the top. On January 1st, year 1, Vertex Industries enters into a lease for office equipment. The lease requires annual payments of $50,000 with the first payment due immediately on January 1st, year one. And by the way, you may be thinking, why is this always due at the beginning of the lease? This seems to be pretty frequent. It's not always going to be due at the very beginning of the lease, but a lot of times it really is. So let's keep going. And subsequent payments at the beginning of each year for the next 4 years. Ownership of the equipment transfers to Vertex at the end of the lease term. The implicit rate in the lease known to Vertex is 5%. The present value of an annuity due factor for 5 years at 5% is 4.546. Vertex incurred direct costs of $5,000 to acquire the lease. For similar assets, Vertex amortizes the ROU asset on a straight line basis over the lease term. So with all that information, again, we have to figure out what the carrying amount of the right of use asset is at the end of year 2. We've talked about a whole bunch of different things in this video, but we haven't talked about this directly yet. So if you don't know how to do it, that's okay. We're going to look at the answer together to learn how this works. All right, here we are. The answer is A, $139,380. That is the amount of the right of use asset at the end of year 2. So let's walk through this. The carrying amount of the ROU asset is calculated as the initial ROU asset value less accumulated amortization through year 2. Straight line amortization is applied as specified by Vertex's practice for similar assets. And by the way, that's what you typically do when it comes to finance leases and their ROU assets, how you amortize them. You typically amortize them in a similar way to what you do with other assets that are similar to it. So in this case, similar assets to this ROU asset are amortized on straight line basis. So that's what we're going to be doing in this case. So let's walk through this. Step 1, we calculate the initial ROU asset. We've done this before, but now there's direct costs to include. So let's talk about that. The ROU asset is calculated as the present value of the lease payments plus any direct costs incurred. So if there are any direct costs incurred with getting the lease, then those are actually included in the right of use asset. So we figure out the present value of the lease payments, $50,000 multiplied by 4.546. That's the correct present value factor, $227,300. Then we add the $5,000 of direct costs. So the initial right of use asset is actually $232,300. Now that we know that, we can go ahead and do the amortization for the rest of the years. The amortization base is $232,300. The lease term is 5 years. So we divide $232,300 by 5, and that gives us $46,460 of amortization each year for the right of use asset. So we go and do that for year 1 and year 2. $46,460 multiplied by 2 for year 1 and 2 is $92,920 of accumulated amortization so far for the right of use asset. So that means that at the end of year 2, the right of use asset has gone from $232,300 less $92,920. So that makes it down to $139,380. That's how you do right of use asset amortization, mainly when it comes to finance leases. And with that, we've gone over a lot in just 5 questions. Before we do anything else, let's do one more part of the Superfast CPA process called pillar topics. Now, the idea behind pillar topics is as you're going through the questions to learn the material, you will notice the things that keep popping up. You see 3 or 4 questions trying to teach you how to calculate the initial lease liability after the first payment, or how to calculate the carrying amount of the lease liability at the end of year 2, or so on. You're going to see these things over and over again in the questions that you're doing. These are the things that keep popping up more than the others. And these are the pillar topics. These are the things that you need to know for the exam more than anything else. So you take a moment, you write down these pillar topics in your own words, basically, again, the most important things you learned from the questions that day. And as you do this each day, you're going to be building your own personal repository in your own words of the most important information that you need to know for the exam. So let's go ahead and look at the pillar topics for this video. All right, here we are at the pillar topics. Let's go ahead and just dive in. The initial measurement of the lease liability, that's one of the first things we need to talk about. The lease liability is measured as the present value of lease payments discounted using the implicit rate, if known and lower, which typically you will see that, or the lessee's incremental borrowing rate. Rarely will you see it use the incremental borrowing rate, but you need to know that you only use the implicit rate if it's known, so if you're given the implicit rate, and if it's lower than the incremental borrowing rate, which frequently that will be the case, but you need to know that. Let's go on to the right of use asset. The right of use asset equals the lease liability at inception, adjusted for any direct costs, prepayments, or lease incentives received. And as far as the amortization of the ROU asset, for finance leases, the ROU asset is amortized on a straight line basis over the useful life if ownership transfers or a bargain purchase option exists. Otherwise, it is amortized over the lease term. And we didn't talk about that explicitly, and we're going to dive more into that in the next 5 questions for the pro members. And again, for finance leases, the ROU asset is amortized on a straight line basis. I mean, technically, it can be amortized similar to other assets, but a lot of times it's going to be straight line basis. over the useful life if ownership transfers or a bargain purchase option exists. So if one of those two things is the reason that it's a finance lease, you actually use the useful life of the asset for the ROU amortization. Otherwise, you use the lease term. And again, we're going to dive more into that in the next 5 questions for the pro members. Let's go to the interest on the lease liability. Interest expense is calculated using the effective interest method, and we've done that in other videos with other different things. Again, you apply the discount rate to the carrying amount, and that gives you the interest, and you subtract that from the lease payment, and that gives you the principal reduction that you subtract from the lease liability, and you do that each period. And finally, for the journal entries for lease accounting, at lease commencement, you recognize the ROU asset and the lease liability. Typically, they're the same, but just a reminder, with the right of use asset, it might also include the direct costs. Subsequent entries record interest expense, amortization of the ROU asset, and payments reducing the lease liability. And with that, we've gone over a lot in just 5 questions and in the pillar topics, and that is the end of the YouTube version of this video. If you liked this and you like our other videos, make sure you go to SuperfastCPA.com and check out our free 1-hour training webinar where, again, we go over the key ingredients to passing the CPA exam, something you don't want to miss. We will teach you how to pass the CPA exam without wasting months or even years of your time in just 1 hour for free. And after you watch that, you're going to want to learn more, so make sure you check out the SuperfastCPA Pro course, because the Pro course takes the 1-hour webinar and goes way more in depth on exactly what you're supposed to be doing every day. And also, SuperfastCPA Pro members get access to the full 10-question versions of these YouTube videos. So the pro members, after I finish this 5-question version, I'm going to do another 5 questions with them where we're going to dive even more into these topics to make sure that it sticks and to make sure that it makes even more sense. So if you like all this, make sure you become a SuperfastCPA Pro member. Make sure you check out the SuperfastCPA training webinar. And with all that, I hope you liked the video. Make sure to like it and leave a comment if you did, and I will see you in the next video.